Hey traders and investors, it's Serge Berger here. Managing your own money, becoming a self-directed investor or trader is can be confusing at times, but I will tell you that for the most part, people do make it more complicated than it should be because of the very simple fact that most people are held captured by basically an information overload that the information age has brought upon us, and we just don't exactly know how to deal with it. So, what I can tell you though, one of the most simple things that I tell people when in the mentoring programs, and just generally when I speak with traders, uh, is essentially the fact that if you can just figure out when you shouldn't be doing much activity, whether that's trading or adding to your longer term positions, if you can just pinpoint that very thing, you will automatically likely outperform, the most of your peers. Let's put it that way. So if you just go back simply, I'm just going to show you this by way of the simple S&P 500 chart, and I'll follow this up at some point in the next week or two with a bit more of a PowerPoint type of presentation. And if you got questions on this, please do let me know. But basically, just look at, for example, the price action year last year, 2014. Okay, anytime we have a dip, and this kind of goes within the statistics that we have for longer term too. Anytime you have a dip between 5 and 10%, you should be looking to start buying, whether that's tactically speaking or from a very near term basis. So that's a simple fact. In other words, when the stock market is dropping, if you're a more tactical investor and someone who just kind of doesn't want to necessarily be a trader, but someone who wants to be a little bit more just taking care of your own money, you probably shouldn't do a whole lot when the market is dropping. Okay, like for example, last October and the first part of September, and then for last part of September and the early part of October, there really wasn't a whole lot to do for you in that case. There was some stuff to do for those who want to be quick and short, but that's another topic for another day. Also, look at, for example, the period between March and let's call it end of May. Very, very boring period. A lot of sideways, choppy action, not just in the S&P 500, but also across sort of the sectors, single name stocks. Fast forward again to early this year, January, very, very choppy market, and really this year, except for a move higher in February, which came on a lot of you know non-confirming signals from an inter and intra asset class perspective. Um, it wasn't really a whole lot to do. So if you can pinpoint those times to be active, which a lot of times actually is after a 5 to 10% drop, you want to start getting active. So 5% drop, 10% drop, that's when you want to start getting active. Or if you start to see market break out clearly higher with a lot of broad participation, that's another way of looking at becoming more active directionally. By the way, the breakout that we had earlier this year was certainly not at all anything that came on high momentum, nor was there a lot of participation. So this is a kind of simple tip that I can give you, and again, that I teach in all the mentor programs and everything else that I do, because it just takes a few things to really focus around that we can dramatically increase not just the probability of making money, but just the actual, in absolute terms, the returns that we're going to make year in and year out, and also in a lot less stressful way. So I hope this makes sense, guys. If you've got any questions, head on over to thestudytrader.com. Check out what we're doing over there. Otherwise, you can hit me up on Twitter. My Twitter handle is StudyTrader, and I'll see you in the next video.